Well, good morning, everybody. It's August 2nd. This is the weekly review where we go over what happened last week, what it might tell us about the coming weeks. This format today is a little bit different in that I've put some member questions in. I want to try to highlight and consider thoughts, feedback, questions that you folks have. So, if you have questions, just send them to me. My email address, of course, is tat@tatoday.com. If you send them to me, I'll try to include them here, and use this as a forum to not only address what I see, but potentially what you see, questions that you have, things that you're thinking. I can't say that I'll get to all of them if there's a bunch of them, but I'll pick and choose some, and even if I don't highlight them here, I'll certainly will respond to you. As far as what happened last week, we were up. We had that week start to the beginning of the week. If we pull the S&P 500 up, for example, that's pushed down here on Monday, followed by again another push up in the range, and here we are again, kind of the high end of the middle of the range. So the story out here remains the same, and that is that it's a big range, not only here but in Europe and probably in Asia. So to start with, let's just pull up the ranges. I pulled over the weekly chart. You got this big range. It goes back to February. It's been in place since then. You had to push up into February that established basically the top of it, and then you have the bottom down here. So there's still swing point lows, haven't been broken. Those are still at risk to be broken. They're not that far away if in fact this market wants to push down. The volume on this bar here is the big volume. That's this area here, and as you can see, each time we've come down to test that area, right, in terms of the test of a downside, that area has been defended over and over and over. So, whether or not we're going to be able to break down to the downside remains an open question. It's certainly a possibility. Consolidation, distribution, we don't really know. We don't know until we get farther along and we see a break to the top side or to the downside. And that really is the way this thing sets up. If we look over at Asia, so looking in Asia, what we're going to see is that on some of these indexes, actually most of these indexes, they're pushing to the downside. They've already broken on daily time frames, and I'll just look on the weekly on the rest. This is Taipei pushing into the bottom with volume. If you look at Indonesia, it's the same thing, pushing to the bottom, pushing there with volume. And if you go across almost all of these indexes, with the exception of Japan, which has a kamikaze style QE taking place, all of these are either at or near their lows, certainly on a daily basis, but even on the weekly basis, many of them are doing the same thing. This is Korea. Looking at Japan, this is on a weekly basis. You can see it's still on the top side of the top range. And then, of course, if we look at Hong Kong and Shanghai, that's the Nikkei monthly. Let's look at the Hong Kong market. Here on a daily basis, this one's trying to push into this July 8th top. So far, it hasn't been able to get into it. So Hong Kong's still, more or less bordering on trying to get to the bottom of the range. You got a high volume low down there. At some point, this thing is probably going to come back and test it. That, of course, is part of this big range now that's roughly 6,000 points. Swing point low test is way up here, so that's a long way up. It's going to take a while before it gets there. It actually tested into this low first in terms of how it tested, and that test, as it got up into there, it pushed back down. So I wouldn't call this no man's land, but this is kind of a key area. If you trade back into this and stay into it, let me redraw that and bring it down. It's right about there. If you get into it and stay into it, then you're going to try to test the bottom side of it. If you look at the weekly, of course, that's a big push down, that big spike down that blew everybody out, including myself. And then if we look at Shanghai, even though I've kind of dismissed this to some degree, given all the intervention that's taking place. Technically, this thing's still trading pretty interestingly well, and that is that it's respecting this low, as we were talking about, that's kind of a key one. If it gets under it, then of course it's going to try to break down the lows. But so far it's holding. If you look at it from a different perspective, what did it do? It came back and did the retest regen here and pushed back lower, which is what you would have expected. And if you look at it on the weekly, your volume low here was a retest regen bullish into this prior swing point high. Hit it with more volume, so you would think that this would get tested at some point. Now, the ideal thing from a bullish perspective on this bigger range that's up here now is that you push into this low, you test it, you don't break it down, right? And then you finally get to push back all the way up to this area. So I would, venture to say, this next week or two or whenever it tests into these lows is kind of the key spot. Because if it sets up a range that holds, then it's tradable. Whether you trade this, you trade Hong Kong, you try to trade maybe Japan, whatever it is, Asia then would have some sort of an established low on a big range, a huge range. It makes it tradable finally. So that's kind of the way the Hang Seng is set up. One of the things that I talk about later in the notes and that we should note is that no matter whether we're talking about Asia or we're talking about Europe, all of them have a range, US. Whenever one of them breaks that range, and let's look at the weekly here on the French market, when one of them finally breaks the range, the key is going to be that break. And if we get that break, and I'm just going to draw in the range here, if we get that break, it's at that point, right up here or down there, that we're going to have significant movement probably around the world, not just in that market. So the point is that we should continue to monitor all three of these markets, Asia in particular now on the downside, Europe as it tries to come back to the top side, and then of course the US markets as well. Whenever one of them breaks, I suspect we're going to see sympathy in all the rest of them. So moving back to the notes here, I've covered a lot of what I was going to say, and that is that the ranges is still in the the primary mover of these markets. Is still holding things into the range, right? Any attempt to break out or to break down, most of the earnings are into the good earnings are already into the market. So whatever kicker it had is probably already taken effect. I just showed you Europe and I showed you Asia. They're all in the middles of those ranges. The positives, if I look at the technical positives and the negatives, what looks to be positive to me is this longer term bias still remains to the upside. And I don't care what market I'm looking at. If I look at China, for example, on a monthly basis, you still have this upside bias that's taking place here. You have it here, you have it in the US, you even have it in Asia, even though Asia has been somewhat of a roller coaster lately. So that long term still remains to the upside. The major drivers of this market are still holding. They're bullish retest regens and they're trying to regenerate higher. So if I move back over to the US market, let me grab that real quick and look at let's just pull up the NASDAQ and look at it. That push to the top side, the breakout that occurred right here, it's a retest regen that's taking place right now. I'm on the weekly time frame. Comes into it, it's doing the test, it's going to try to regenerate higher. And again, as I was saying, the upside bias is still this direction. It hasn't changed. Now this one is back up here testing that high. It's still testing, in the range. If you draw the range out, the prior range was really about here. It's still holding in it, but it's right at the top trying to break above it. Is it going to extend it and create a higher range? We don't know that, but we know the biases are that direction, so we have to respect that, the probabilities are such that would happen. If we look elsewhere, like sectors, all of these are still supporting this move. And these are major sectors, XLF, the XLK, the XLY, the XLV. Those are big drivers, and they're all still pointing to the upside. On the negative side, the driver continue to be negative drivers, XLE, XLB. Even though the IYT is doing its bounce, that still is a negative driver. So what has driven this market up and held it in this range, and what keeps trying to bring it down out of this range, continues to be in effect. They haven't changed. If I look at the technical negatives, Apple's starting to break down as a big negative. And let's look at that one. And it's a big negative because Apple is such a huge weighting in not only the NDX but all the others. Here's the breakdown. You actually turn to the negative now, right? Transitions to negative. Broke on this time frame here to go sideways. Broke again Friday on this time frame. It's going to try to trade back into this bar now. This bar is back here. That's the lows basically of the past month or two. Actually past several months. It's going to try to trade back into this and test this low. Now last time this low tested this bar, didn't have the volume at all, flipped around and got a nice bounce. Next test into it is a key one. That also is a retest of this bullish retest regen. Remember, the more times you hit it, right, the probabilities decrease that it's going to hold. So Apple's going to be a key thing to watch in the coming week or weeks as it comes back to try to do this retest. And that's going to affect the NDX, and it's going to affect other markets as well. Other drivers, China we just talked about. Commodities remain under pressure. I mean, if we look at the commodity space using the continuous commodity ETF, the Greenhaven commodity ETF, you can see here on a daily this thing is totally broken down again. And that's because you've got all, I mean, actually you've got everything breaking down. If you look at it on the weekly, it's broken down as well. And just as it should do when it breaks down on multiple swing points, multiple time frames, it should get an extension. It's doing that. 2 to 3 bars you can expect. This is bar 1. You can expect another one. So that doesn't look to change anytime soon. And that, of course, is putting pressure on these indexes or ETFs in the sectors as well. Big cap integrated oil. This one really got hit. Let's look at a couple of these. Here's ExxonMobil earnings on Friday morning. Took a big hit, plunging towards the bottom. Volume expanding tremendously. You also had CVX doing the same thing, and it actually broke out the bottom again. So you've got major devastation continuing to happen in this space, not only on the daily but on the weekly basis. Just continual drive lower, and that's of course putting pressure on the XLE. Money still moving into bonds. If we look at bonds, they saw a bid again. You can see it here. You know, even though it tried to pull back, you end up spiking again. Had some volume on Friday. This is pushing up to test these highs, and that swing point high. Well, we don't have it on the weekly, but we have it on the dailies. That push back up to test these highs is over here. What is that? 124.53. And really, you know, on the way back up, I could see these bouncing as long as these markets remain under pressure. You know, in this range, I could see this bouncing all the way back up to this level off this big swing point high retest back up here again. So, you know, bonds pushing higher, nothing major yet, but if they do start to push and do start to push hard, right, back up to this level, of course that doesn't change the idea that you have some sort of an ABCD structure potentially on the downside, right, even a bounce up to here, but the point is that if bonds are moving higher, usually the market's not going to break out. So that question of whether we break to the top side anytime soon, bonds seem to be arguing against it. So that, to me, that's a negative. And the other negative is probably the biggest one out here is the dollar. You know, the dollar now still hasn't broken out, but they tried to sell it off Friday on some news, some economic news, and instead of staying down, this thing reversed and headed straight back up. You know, this dollar keeps signaling that the Fed really is going to raise those rates, even though the market doesn't seem to either A, care, or B, has already priced it in. And that push up, if we get back up to these swing point highs, and if this range eventually does break to the top side, which I think it will, you know, if that's the case, right, then you're going to see these equities again have pressure. This is the key area. This swing point high is the key high. If we move up and over it, then you got to think the top again, or at least think this little range up here at the top. And then that, of course, once it breaks to the top side, if it does up here, that, of course, is going to be a continuation of this big trend. And you have to think, if you look at it on a monthly basis, that's going to show you, let me pull up the monthly here. It's going to show you a continuation of a large trend on the upside, and believe me, that one's going to cause some grief if in fact that's what happens. So the dollar, to me, one of the biggest negatives against the equity markets, at least at this particular point in time. And I think it's going to be a huge negative on some of the emerging markets as well. Anywhere where there's dollar denominated debt is going to be a big issue, because to service that debt is going to get more and more expensive. So it's going to cause ripples is the point. Fundamental positives. Let's see here. Oh yeah, fundamental positives. You know, the Fed still hasn't given us a timetable, but they still are saying, you know, a negative here is that they're still saying that they are going to raise rates. The fact that this market continues to be bought on any dips has to be viewed as a fundamental positive, and it has to be viewed as telling us that the economy is still okay. But believe me, if the economy was looking like it was going to go off the tank and the market started to sense that, we would see lower prices. But the fact that we keep holding says that that's not the case. The economic numbers, even though they disappoint, you know, especially in the emerging markets, you know, for the most part, they're holding. And, you know, the negative is over here in the emerging markets like China and some of the other places where we're seeing the weakness. What do I watch for, or what should we be watching for? You know, the ranges continue to be in effect here, over there. If they start to move in either, you know, Europe, Asia, or the U.S., it's going to have an effect on the rest, so we just should monitor all of them. Any of those that start to break down or break out, we have to assume that it's going to have a pull effect on the other markets. All the potential negatives didn't play out last week. All the potential positives the week before did not play out. So what does that tell us? It's just a range. The range hasn't changed. It's still the same. Economics this week, you know, you got a lot of data, a huge amount of data actually. Employment number on Friday, the manufacturing service PMIs, the industrial production numbers. Again, another glimpse of where the economy is and where it's going, and those will be market affecting most likely. What's the bottom line here? August, September tend to be some of the toughest months in the market. So any sustained breakdown that occurs is likely to see continuation. And what I mean by that is those swing points that we see across multiple time frames in any of these indexes we look at, but looking at the S&P in particular right now, all of these swing points that are lined up fairly close, right, on this range, right, those two, if they start to break, we are likely going to see it push to the next set. And so this support zone would be where you would expect price to move. So, you know, at this particular point in time, these remain the key areas to watch on any kind of downside break. And if they do break, you're probably going to see follow through, and that's what we were just talking about in terms of the ranges. When you have markets that basically go nowhere and they're chopping back and forth, you know, historically, what I've found to be most effective is to just narrow your focus, trade only a few stocks and ETFs that you believe in longer term, you know, trading idea. In other words, if I believe Europe's going to go higher longer term, that would be a place that I could trade those ETFs. If I believe that a particular stock, you know, for example, you know, we've got Starbucks in our portfolio. If you believe Starbucks is going to continue to do well, and fundamentally negatively, I don't see anything to stop it. That's something that you should try to buy on dips and just focus on those few stocks, those few ETFs. And forget the trades. The trades just thrash us, and we've seen that again this month. We saw it last month. I got sucked into thinking that we were going to get a breakout, and it cost me. You know, so, you know, my advice is keep a good portion of the money in cash. When we do get a sustained break and we push down, if it looks like we're going to get a turn, or even if it doesn't, we will get a big bounce off of it. That's when you deploy the cash. That's where the money can be made. With the bias being to the upside, we have to focus more so on the upside and not the downside. If we get a sustained break to the upside, again, that would be something that we could deploy some of that money on that first retrace. So it's the sustained breaks that we're looking for. We want to focus narrowly on things that are working and forget everything else. I talked about the top of the show, I do some member questions. So there was a couple of them this week. One of them has to do with the euro unhedged and hedged portfolios. What do I think the euro is going to do is really the question here. And I believe that euro is eventually going to break to the top side. And so let me pull up the euro, to the bottom side. And I think that will push the European equities higher. And I think that will favor the hedged ETFs initially. Once it reaches whatever the objective is, then I believe the unhedged ETFs are the ones to be in, because these hedged ETFs benefit from a weaker euro. So looking at the euro, we looked at it a little bit earlier. Here's the range. What you really want to focus on is here. This is the weekly chart. You have what is probably a large move down still to come at some point here. How long this thing trades sideways is a different question, right? But at some point, this sideways range that has developed is most likely going to be a continuation range to the downside. And you want to be short this index, which is the EUO that we've been trying to trade, and you want to be long the hedged ETFs, because that's going to hedge out the currency risk, and it's going to benefit from the push up that's probably going to take place in those equities as that currency that they trade in gets cheaper. And so this continuation move is most likely not over. It's probably going to continue, and the key bar is going to be here when it comes back down. So about this 100, what is this number here? 104 point is where we should be looking. We're trading at 107, so you could get another 3.5 down to test. If it eventually breaks, then you definitely want to be in the hedge. As it gets down in here to test, it might be where you take a little bit of those hedged off. But I still think, you have to go with the trend. The trend is on the downside, not on the upside. And looking at it on monthly, what's the risk of this? Well, the risk still remains a retest regen back to here. That would make it tough on hedged ETFs. But so far, we don't have evidence that it's going to make that move. We still have volume at the bottom. And any attempt to get over that so far has failed, to get over it and stay over it. So the range is here. You have to expect a continuation of that push eventually. And if that's true, those hedge ETFs are going to be the place to be. How far can it go is the other part of the question. If you just do the ABCD structure that's in place, so far that's all we have on the bounce. That's a huge ABCD structure to the downside. You went from about 140 almost, about 138 to 102, so you lost 38 of it. You bounce up to 12. If you take 38 off of that, that takes you down into the 80 range. If you do the weighting versus the relative weighting versus percentage move versus just the absolute numbers, I think the $90 mark is probably a good mark to think of, and so that's probably where I'd be thinking in terms of a target. The other question had to do with DGI, and for those of you who've been around, DGI was a stock that we did traded it successfully. Of course, like most stocks, we got caught in it when it started to move against us, but we exited it and just got out of it, and pretty much have forgotten it since then. So the question is do you see anything in it? This particular member likes the business space. This company, he wants to know whether it's a dying company or whether it actually is going to be able to still make it. Fundamentally, the benefits he sees is that it has just little exposure to the overseas market, and it's a strong U.S. economy. It should be benefiting. Let's look at the charts on it and see that it had earnings on Friday, got really whacked. It actually beat on the earnings, but it got it down in terms of the forecast. This thing has dropped precipitously from about 32 to 21 now. So you're down almost a third, or as much as a third at this point. If we pull it back on a weekly, you can see it broke a swing point low here. Didn't have the volume, but it's well underneath it. And if you look at it on the monthly, it's broken a swing point low on the monthly as well. So, when I look at a chart like this, is this a chart that I want to be invested in, especially at this point in time where we're range trading in the indexes? And, if I go back to, what I talked about previously, up here, is that you really want to narrow your focus to just the strongest stuff. And you want to stay into that, and you just want to try to ignore everything else. So when I look at, this chart, I don't see a reason to be in it. I don't see any reason whatsoever to be in it. And if they do put things together, then maybe it's worth investigating it again somewhere down the road. But when a chart's breaking down, there's no reason to be in it. And so, if you're asking my opinion is I have no idea why that space isn't working. I know a lot about that company. I actually did some work for them at one point, and I know what they have. I know they bought out one of their biggest competitors. I also know that their biggest contract is with the Defense Department, and if the Defense Department decides they don't want to run those contracts, then they're not going to make as much money. And I don't know if that's what's really pushing here, or maybe it's just the takeover of the other company. Maybe the synergies weren't there that they were hoping to get. So whatever the case, right now you can see they're having problems in their business space, and I would avoid them. Portfolio, I've pretty much covered everything. I got out of a lot of stuff last week, for good, for better, or for worse, and said let's focus on the more narrow. I've already covered almost everything is here, and then I've got the strong, weak sectors down here again. A couple additions on both sides, but you can look at those. You need to concentrate in the strong and stay away from the weak is the way it is. And whether you're following what I'm doing or you simply using me as a guide and doing particular things on your own, which a lot of you do, those would be the sectors that I'd stay away from, or the weak ones, and I'd stay in the ones that are strong until we see evidence that they're changing. All right, that's it for this week. It is more range. I don't see anything stopping that yet, and I suspect it's going to continue for a while longer. I think the real risk is a downside push, and if it does come, I think it opens up a real opportunity. So let's keep our minds focused on that possibility. So I'll close for now with the same thing that I do usually, which is, if there's anything I can do to help you, just drop me an email. I know that one of the members is asking me to do a few things having to do with projections. I'm going to do a short video after this, and we'll probably post it to the member video site, trying to tackle his more in-depth question to try to help with respect to being able to judge when you know you're wrong in a trade and when you don't. So I'll be tackling that here in a bit. But as always, just ask me if you have questions, anything I can do to help you. And if you want to submit some questions for, the whole member group for me to tackle here, please do so. Until next time, take care.